Next up, I'd like to introduce Victoria Bennett. She's the Strategic Marketing Principal at Bennett Milner Williams Consulting, and she'll be delivering a talk on the art of securing investment during a recession, insights on effective strategies for entrepreneurs in Canada.
Before we even discuss surviving a recession, we need to agree on what is happening in the world. During COVID, people stayed at home and spent less. They saved up more, businesses got government support, and many companies actually improved their financial status. Coming out of COVID with the war in Ukraine and supply chain issues, although we saw spending increase, people are wanting to be a bit more financially stable. And especially since early 2022, where we've seen massive increase in inflation at levels we haven't seen for many decades, that's put fear into people and businesses to pull back spending and drive toward recession. Canada's GDP growth is expected to fall below 2% during 2023. The federal government is expected to cut the budget, and the small business confidence indicator is levels only seen around recession periods. A strong job market recovery, household savings, high commodity prices, and strong demand for services after COVID restrictions has fueled growth in 2022. But the Bank of Canada raising the key rate by 400 basis points in 2022, bringing the policy rate to 4.25, will significantly impact businesses and business loans that are traditionally well above base rates. The data suggests we will go into recession, but that it is not as deep as it was once feared. I think a glass is 2/3 full, and we have to note that recessions also are the breeding ground for some of the most successful companies like Amazon, Netflix, Uber, and Airbnb. And these were all founded and grew during recessions because they focused on meeting a need more cost effectively and leveraging innovation. Amazon was founded in 1994 during the dot-com bust and grew rapidly through the 2001 recession. By focusing on low prices, convenience, and a wide selection of products, Amazon captured a large share of the online retail market and became one of the world's most valuable companies. After the 2008 financial crisis, companies like Uber, Netflix, and Airbnb also saw significant growth, as many people sought cheaper transportation, entertainment, and accommodation options. These platforms provided a convenient and affordable solution. So, if you have a brilliant business idea, you have the passion, the vision, and the drive to make it a success, but you need the money to get started. Where do you turn for funding? Do you go to the traditional route of seeking a bank or credit union loan, or do you seek out venture capital or equity crowdfunding? Traditional funding sources are difficult to secure. Venture capital is hard to come by, and equity crowdfunding is a relatively new option. In today's fast-changing economy, the choice can be overwhelming. Traditional funding sources, such as bank loans and lines of credit, are typically secured through financial institutions. These institutions are often risk adverse and may require collateral or a strong credit score to secure the loan. While traditional funding can provide access to large amounts of capital, the application process can take time and effort. On the other hand, venture capital is typically provided by private investors looking to invest in high-growth companies with much potential. Venture capitalists often take an equity stake in the company in exchange for their investment, and they may also provide guidance and mentorship to help the company grow. While venture capital can provide much capital quickly, it can be challenging to secure, and the terms of the investment can be very restrictive. Finally, equity crowdfunding is a newer option that allows businesses to raise capital from a large group of investors through online platforms. It's typically easier to secure than traditional funding or VC, and it can give businesses access to a broader pool of potential investors. Traditional funding can include bank loans or lines of credit, grants, bootstrapping, and friends and family. Having supported companies raising capital for nearly 10 years, I recommend all companies to think and plan as if you are bootstrapping to live within your means. It makes you think about deployment of capital, using funds wisely to have the greatest impact on your business. It will extend your run rate by lowering your burn rate. At this time, I would also look for grants, as these do not need to be repaid and they are non-dilutive. Often they can be balanced with other funding mechanisms to maximize the capital that you raise. When discussing traditional funding from financial institutions, often alone, this is the preferred method for established businesses as they have a track record of success. A noodle company came to me last week wanting to raise capital to expand their facility. Because they have strong revenues, it made sense for them to go and talk to someone like BDC to secure the funding. And if they wanted to engage their community, they could do a smaller crowdfunding raise and get the vast majority of their funds through BDC or similar. So traditional funding typically has lower interest rates and is built on established relationships between the financial institution and the business. It allows companies to maintain more control over their operations and decision-making processes, but there are high barriers to entry. You often require a significant amount of collateral, the approval process can be lengthy, and there is a risk of default if a business cannot pay a traditional loan. Typically, this option is more open to established businesses, but I have heard recently that banks are asking for not just 3 years of historical data, but 3 years of pre-COVID historical data, which closes the door to new and existing businesses. In addition, during COVID, businesses and individuals' credit ratings improved due to the lack of spending options and government grants. But in the current climate, these credit scores are declining quite rapidly, making traditional funding more difficult to access. Venture capital is an attractive funding option for businesses with high growth potential that require large capital to scale quickly. Look at it as rocket fuel. Venture capital firms typically invest millions of dollars, making it attractive if you need significant capital to grow quickly. In addition to funding, venture capital firms often provide guidance, mentorship, and access to networks to help businesses achieve their goals. Many VC firms specialize in specific industries, allowing them to provide expertise and guidance on industry-specific issues. Securing VC capital can signal to other investors, potential partners, and customers that your business has significant growth potential. But with that can come the loss of control. VC firms typically require a significant stake in your company in exchange for their investment, which can result in loss of control for the founder or founding team. There's enormous pressure to perform. VC firms can expect a high rate of return on their investment and will often put pressure on the company to meet growth targets and achieve profitability quickly. There are limited exit options, with VC firms typically expecting an exit within a specific time frame, either through an acquisition or an IPO. And this can limit your options for future growth and development. As more rounds of funding are secured, the funder's equity stake in the company can become diluted, resulting in less ownership and control. And ironically, making your business less attractive because investors feel you as a founder may need to be more motivated and committed to the company. Canadian VC activity in 2022 closed with the second highest deal count and total deal value on record. But this was driven by the momentum from the 2021 highs. And the first 3 quarters of 2022 still showed a decline. And in Q4, capital did show a slight improvement. But market uncertainty still impacted companies seeking capital through the public markets in 2022. And if we look as to how VCs make their money to invest in the next generation of businesses, most notable is the fact that there were no IPOs. And in addition, the annual exit value saw a massive decline from the previous year, the lowest on record. And M&A activity also slowed down in 2022. So there's potentially less VC money to go around. And as VCs have increasingly become the dominant source of early stage funding, in 2023, they are now more selective about investing in true innovation rather than stability and long-term scale. In 2023, more and more companies have adopted crowdfunding and other alternative finance methods to support their projects. Alternate investment sources offer advantages that traditional ones do not, such as increased access to retail investors. Online portals create greater transparency between companies and investors and offer faster access to the funds needed to realize the full potential of a project or business idea. Moreover, startup owners have greater control over the investments they receive through these platforms than having a limited say over venture capital options. One of the advantages of equity crowdfunding is that it allows entrepreneurs to raise capital without giving up control of their companies. Unlike VCs or traditional lenders, equity crowdfunding investors don't typically require a seat on the board of directors or a say in the business's day-to-day operations. However, equity crowdfunding also has some disadvantages. One of the biggest is that setting up and managing an equity crowdfunding campaign can be time-consuming and costly. Crowdfunding, in particular, has become a widely used source of alternate financing due to its lower cost options and wide reach to the 97% of the population who have been unable to invest before and may be potential investors. As such, small businesses can receive the necessary funding from anyone who believes in their product or service idea and is willing to promote it and become an ambassador for your business. In Canada, the crowdfunding exemption is set at 1.5 million, which may not be enough to achieve your objectives, which will require a blended approach, including angels, VC, or even government funding. Alternate financing has revolutionized how investments are made by giving greater power to entrepreneurs looking for alternate solutions for unconventionally funding their business ideas, as well as opening up opportunities for everyday people that were previously only available to sophisticated VC firms. Alternative investing will likely remain an attractive option for entrepreneurs in 2023 as well, offering increased access to funds this year than ever before. Research conducted by the World Digital Foundation with Crowdfund Insider showed that 80% of the private companies raising capital in 2023 would consider equity crowdfunding above venture capital. PitchBook data in late 2022 also supports this, reporting that equity crowdfunding is now second only to VCs and private equity for funding startups, while RegCF, the US equivalent equity crowdfunding alone, is supporting 300,000 US jobs. So although 2021 was the largest year for equity crowdfunding globally, in 2022, the reduced economic activity knocked that back. But still, the average amount raised was $428,000, with the average investment just over $1,000. My challenge to you today is to consider crowdfunding. In the US, there were only 1,584 campaigns last year. In the UK, 600 campaigns, and far, far fewer in Canada. A fraction of businesses are using crowdfunding to raise capital, yet we can see it should be on your radar when raising capital. If we look at private money, according to the Bank of Canada's latest data, from 2021, approximately $2.2 trillion of Canadian is held in currency and deposits. Given that households on average invest 10% of their income, you could assume that means there's about $220 billion in investable assets currently available in Canada. According to data from the Canadian Venture Capital and Private Equity Association, in the same year, 2021, venture capitalists invested 6.7 billion Canadian across 614 deals in Canada. So in 2022, crowdfunding was the only private market that showed year-on-year growth. VC funding declined, exits declined, and add to that, if you consider crowdfunding, you're opening up access to a potential $220 billion versus 6.7 billion in VC funding. The need here is to find an effective way to shake the mattress and release that funding to support Canadian businesses. The UK identified this in the last recession and realised that with banks and VC funding being less available, they could release private money and provide the funding that businesses need by putting in investment tax supports for crowdfunding. It's why the crowdfunding has the most advanced crowdfunding regulations and has brought crowdfunding mainstream, and still it has room to grow. So when you are comparing the performance of equity crowdfunding, venture capital, and traditional funding sources during a recession, consider the following factors: the availability of funding. So during a recession, traditional funding sources like banks may become more risk adverse and less willing to lend money. This can make securing funding more difficult for startups and small businesses. Whereas on the other hand, equity crowdfunding and VC may be more willing to take on risk and provide funding. The cost of funding. During a recession, usually interest rates are lower, which could make traditional funding sources more attractive, but that's currently not the case. Equity crowdfunding and venture capital may offer more flexible terms and be willing to work with startups and small businesses. The performance of funded companies. So equity crowdfunding and venture capital may be more likely to invest in startups and small businesses with high growth potential, which could lead to higher returns in the long run. However, traditional funding sources may be more conservative and focus on established companies with a track record of success. Risk management. So equity crowdfunding and venture capital investments are inherently riskier than traditional funding sources. However, these types of assets may offer more significant potential for high returns. Investors' risk tolerance and investment goals will determine the availability of capital. So, which funding source performs best during a recession? Well, there's no one-size-fits-all approach to surviving a recession. However, equity crowdfunding and venture capital may offer greater opportunities for funding and growth for startups and small businesses. But in contrast, traditional funding source may be more stable and less risky for established companies. The potential for equity crowdfunding is huge. It is not one we have truly explored nor supported as a country, but even in its current construct, it has much potential. But ultimately, the best option will depend on your specific needs and goals for your business.